China is both a critical part of the global growth story, but as we heard from Morgan Stanley, the Chinese recovery may not actually be to the benefit of the world at large, other than perhaps the inflationary impact. Is that because of the way that the economy is being managed to be more inward-looking?
Sure. Well, first of all, it's great to be back here and be back in Australia. It's been 3 years, so it's a pleasure to be back here and be with you today. I actually think China is more of a growth story than many admit. Maybe not what it was 10 years ago, but it's still, in our forecast for this year, is actually closer to 6% than 5%. We think they're going to shoot out of a cannon this year. But it's still an important processor of the minerals that Australia sells and that we're going to use in the West for batteries. It's still an important purchaser of foodstuffs, of soybeans, of corn, of other kinds of grains. And they're still an important exporter of intermediate goods and final goods. They're a huge player in the global economy.
So does that mean, going forward, the guardrails potentially in that US-China relationship and the way that it has a ricocheting effect to other economies around the world, that remains a key theme?
It remains a key theme, but U.S.-China relations are pretty tense. And unfortunately, I think they're going to get worse before we find a new equilibrium. And that has implications globally. If U.S. farmers can't sell soybeans to China, then Brazilian soybean farmers will. So they'll find other sources. But relations are pretty tense, and I think they're going to get tenser throughout the year.
And of course, the China growth story is key, particularly for Australia. You've been meeting with the big banks, with, I know, the central bank as well, representatives from the RBA, the Deputy Governor. What's been the mood when it comes to looking down the barrel of this year and all of the macroeconomic uncertainties, which the markets have really now struggled to reprice?
Indeed. Well, I think everyone's prepared for the down cycle. We have plenty of capital, lots of liquidity. We're less leveraged. Obviously, mortgage rates are going to go up here. I've heard a lot about that over the past few weeks. But I think the bankers are well prepared, and they're actually trying to look through the cycle, anticipating a recovery. We will have a recovery. I think we'll have a strong recovery next year. And are they positioned? Do they have the right people, the right technology, or are they in the right markets?
When it comes to monetary hawkishness these days and the repricing that we're having around the Fed as well, how concerning is the huge amounts of debt loads, not only in developing economies, but now in mature markets as well?
It's a great question. According to our own debt monitor, debt to GDP is now about 350% of GDP globally, 300 trillion. Emerging markets is about 200%. In the U.S., we have accumulated $10 trillion worth of deficits over the past 7 years. So we've been spending money. We've been doing a lot of deficit spending. It's a challenge. Many sovereigns are highly leveraged, and interest rates are going to go higher. I think equity markets are not sufficiently listening to Jay Powell and his admission that he will indeed hike rates to bring inflation under control, which is difficult because the U.S. economy is incredibly resilient.
And we were talking just earlier about this U.S.-China tensions continuing, geopolitical rifts around the world. How inflationary will that be, and does that complicate the global picture even more?
Yeah, indeed. If globalization was deflationary, China exported deflation for decades, then the opposite of that will be true. It will be inflationary. We also have a worker shortage in the U.S., as we see in many parts of the world. In advanced economies, we don't have enough workers. So without immigration, without more workers, without globalization, without trade, prices structurally are going to be higher. So it is indeed inflationary, different than what we've seen over the previous 30 years.
And over the past few years, there's just been, we don't even talk about black swans or grey swans anymore, right? Because I think everyone's a little bit terrified over the shocks that we've seen hit the global economy. But what are you watchful for? Because there's lots of topics that certainly were at the forum yesterday were top of mind. ESG, obviously, what the next part of the narrative is. AI, digital and crypto remains a challenge for regulators. Is it really the regulatory piece that is still uncertain?
And both in the digital space and also with respect to ESG. In the U.S., there's an ESG backlash, interestingly. So we see fragmentation around the world in the way in which many jurisdictions are thinking about climate, which is unfortunate. And two, I think we're at an inflection point with respect to AI. This is accelerating quickly. It's a bit of a black box technology for regulators, so they've got to get comfortable with the technology itself. But, the biggest challenge is how do you think through policy mistakes? Again, U.S., China, those have global implications, and they can be felt pretty quickly.
What's the role that you're hoping the Institute can play when it comes to be able to provide some of that guidance and the guardrails to have the conversations, right, to be able to avoid that fragmentation that you talk about?
Sure, it's just to alert both our members and policymakers to all these risks and identify solutions to the risks. How do we think through artificial intelligence? How do we think through transition risk and transition planning for our firms in terms of adhering to or meeting our climate goals? So a whole range of policy issues that require in-depth research, policy advocacy, and interacting with the public sector.
And so many different stakeholders and points
Many
of view,
stakeholders,
right?
lots of views out there.
Yeah.